Treasury hit up against the debt ceiling, and now is maneuvering around using extraordinary measures to prevent a default on our debt. Now, we believe, most people believe, that these extraordinary measures will be good until some point in June. So in June, and as we get towards June, there will be more drama. A couple of other things happened in the last week to give us the sense that Chairman Powell is getting a little more uncomfortable with the Fed's position. One is that two advisors, or we believe that these individuals advise the Fed, who used to be on the warpath against inflation, have changed their tune a bit. Not that they think letting inflation go is what we should do, but I think they're becoming a bit fearful that that Fed policy might have gone too far after really encouraging the Fed to tighten up. One is Janet Yellen, who is the current Treasury Secretary, and you'll remember the word transitory. She had used transitory as inflation was picking up, and then in quite a dramatic moment, she apologized for using the word transitory, said she was mistaken. This was sometime last year, and really almost encouraged the Fed to act as aggressively as possible. And that's when we started getting the sense that 75 basis points was going to be the norm, not the exception. Well, she's changed her tune, and in this last week, she said something like, once we're through this inflation and we've got it under control, and we seem to be doing that, we're probably going to be facing an environment where inflation and growth are very, very low and problematic for businesses. Another person who has changed his tune fairly dramatically is Larry Summers, who was a former Treasury Secretary. And he was cheering the Fed on last year as it was hiking rates 75 basis points at a time. And he was saying, no, we're going to have to go to 6, 7, 8% to get this inflation under control. And now he's saying, whoa. Ahead of the Fed meeting, he said, don't suggest what you're going to do next. Let's sort of wait and see. Of course, the Fed did go up 25 basis points, and I think that's because it had primed us to expect 25 basis points. But now he's got two advisors who I think were very influential last year, who are basically saying, wait a minute. In fact, after today's employment report, which we'll get into in a minute, Larry Summers said, whoa. I actually think that businesses are going to feel like Wile E. Coyote. They're still hiring like crazy as activity is falling. So, they may be looking over the cliff. So again, very, very interesting. And then the other, I think, most important point coming out of the Q&A after the FOMC decision, so the Federal Open Market Committee decision to raise rates 25 basis points, was Chairman Powell's answer to the question, do you believe we're in a wage price spiral? Lyle Brainerd, another Fed member, does not believe that. And Chairman Powell said, I agree with Lyle Brainerd. Now, that was a very big admission that we are not in a 70s style inflation, which is what they were fighting last year. And again, today, the employment report corroborated this notion that we're not in a wage price spiral. Income is probably, in the month of January, up in 1 month's time, up roughly, it's somewhere between 1.5% and 2%. That's just a sequential increase. So that's, 15% plus at an annualized rate. So that's a boom. It doesn't square with what we're seeing out there elsewhere. We're seeing the challenger job layoff rate up 400% plus in the month of January. We are hearing, the headlines are screaming layoffs. Listening to earnings reports over these last few weeks, one layoff announced after another, or hiring freezes at best. We're seeing the banks take reserves for bad debt, big increases like billions, $1.5 billion, I think, for JP Morgan. There were a number of $1 billion increases. Just in the last few days, we saw reports from Amazon and Alphabet, Meta, Apple, Microsoft, and all of them were showing serious weakness. And advertising is one of the most discretionary of expenses. That actually started weakening dramatically nearly a year ago. And as you know, we believe we were in a recession last year. And sure, we've gotten a bit of a reprieve, but if you look at what happened in the fourth quarter, the GDP statistics, we did get those the preliminaries. Inventory accumulation accelerated in the fourth quarter. And we thought that retailers were discounting so heavily because they were trying to clear shelves. Well, consumption, if you look at the retail sales reports, consumption looked terrible. Now, services bolstered consumption in the GDP reports, but goods consumption was very weak. So, what we're seeing from this employment report does not square with reality.
For more daily dose crypto news, check out these 2 awesome videos on your screen. Click now and we will see you on the next video.